as we meet again, the weather hasn't improved very much, but the economic data and the news and the COVID situation certainly have. So yeah, I'm happy to say that I'm sure some doom and gloom has found its way, because I'm an economist, and there will be bits and pieces of risks and caveats, but generally speaking, the news is pretty good, and I have a more upbeat set of slides to share with you today. But let's start by rewinding a little bit. And 2020 was an incredibly tough year for the UK economy, as we all know very well. Actually, in terms of the fall in GDP, the fall in UK GDP was greater than in most of Europe. Only one exception to that. Sorry, can everybody mute the mic if that's okay? So only one exception to that, and that was Spain, which had a bigger fall in GDP in 2020. And there's a few reasons for why the UK's performance is among the worst. In some people will argue it's because we measure GDP slightly differently, but even if you strip that out, we still were particularly hard hit, and the overriding reason for that is that we are a services economy, and so is Spain, with the tourism, and the more services dependent you are, the more you will be hit by the shutdown of the service sector. In contrast, if you look to the right-hand side of this chart, countries like Poland, Lithuania, these are more manufacturing economies, and as a consequence, even Germany in the middle of the table, they're much more manufacturing heavy, proves more resilient in terms of the GDP performance. But I think another reason, or perhaps a correlated reason for our poor performance, was that our mobility was much less than normal compared to our European neighbours. So you can see the UK here, we are the kind of peachy line, and we're at the bottom of the pack for most of 2020, and just starting to push up now in 2021 on the back of the vaccine progress. But you can see that our mobility was lower than most of our European neighbours. And one reason for that, I think, is that, and I shared this slide, I think last time, we're a little bit too good at working from home. This chart shows you that we were doing it back in 2018, or 1 in 4 of us was. We're quite technologically adept and adaptable, and as a consequence, we're not doing all those things that we usually did around our offices, namely getting a coffee, getting lunch, getting a haircut, dropping off your dry cleaning, meeting a friend for a drink, and also all the other infrastructure around an office, the security, the receptionists, the maintenance staff, the cleaning staff, all of that stuff that revolves around office work, which is a big part of the UK economy, just is only happening at a fraction of what it once was. And because we are quite good at working from home, we didn't maybe go back to work in the summer and as much as some of our European colleagues did. But of course, the clouds are lifting, and we are seeing many signs of a return to normal, including the weird situation in the papers today where our government is telling us we're allowed to hug again, or will be from next Monday. But of course, the vaccine is the key to all of that, and the UK has been at the forefront. We might have been at the bottom of the table for GDP, but we have been at the top of the class for vaccine distribution. There's a few countries that have done better than us. Israel, I think, is not on this chart, but Malta. The US has now slightly overtaken us, I believe, but generally speaking, the UK has done incredibly well in terms of distributing the vaccine, and more importantly, Europe is now catching up. It's all very nice being top of the class, but nobody is safe until everybody is safe from COVID. And so, what we're seeing is good news from countries like Spain and Germany, where they are starting to accelerate their vaccination programs as well, which not only means that we can all go on a long awaited holiday, but also means that business, cross-border business, can start to resume as normal as well, and also prevents the risk of new variants emerging and coming and disrupting everything. Now, this is not a very economicsy chart, but I do find it quite interesting. The percentage of people who think the government is handling COVID-19 well. The UK, again, bottom of the class for much of 2020. since the beginning of the vaccine program has really seen a complete turnaround. And actually it's governments, it's European governments, particularly the German government, that has lost the faith of its population, while the UK starts to see people really believing that the government is in fact doing a good job. And we certainly saw in the election results from last Thursday some of the repercussions of that. Essentially, governments, incumbent parties being rewarded by the electorate for the success of the vaccine rollout and the light at the end of the tunnel. A couple more charts just indicating that return to normality that we are now seeing. So the fatality ratio falling. We all know that deaths are falling, thank God, but the fatality ratio is also falling. So per case, the number of deaths that you are likely to get is falling rapidly. And you can see from this chart that the steepest fall in that ratio is in the over 80s. That's because they were the first to the vaccine. So essentially it's showing you that the vaccine is working. Boris Johnson says the numbers have come down because of the lockdown, not the vaccine, but you know, this chart would suggest a pretty strong role for the vaccine as well, which is good. On the right hand side, a gradual return. We're still not back up to even where we were in the summer in terms of traveling to work and commuting, but certainly pointing in the right direction towards normalization. I mentioned the political implications as well of the strength of the vaccination. Now, the Conservative Party will be well aware that the boost that they had from the vaccination success may not last them through to the next election, but for now, it's doing quite well. You can see the disapproval of the Westminster government's record to date. You can see it's kind of you can see that disapproval fell in the immediate, in the worst of the March 2020 COVID crisis. Everyone pulled behind the government and rallied together. It then rose as the perception that the government had done a bad job handling COVID, and it's fallen back now, including in Scotland. And correspondingly, you can see that support for Scottish independence has fallen back a little bit there as well. Now, this may not last 1 year, 2 years, 3 years down the line. These charts could look considerably different, but we did see from the election results on Thursday that generally speaking, confidence is rising. People are happy with the job the government has done. Now, in terms of the economy, you know, we've had some pretty strong numbers already, and we're expecting even stronger numbers in the coming few months. So these surveys, the PMI surveys, are a forward-looking indicator. So it's companies telling us whether, you know, how much more work they've done in the last month than the month before. And they're all pointing higher. We put the Eurozone here as well to show this is not just a UK story. You know, the manufacturing sector's done particularly well. And that's because even while we're in lockdown, you know, we can't consume services when we're in lockdown. We can't go out and have all the you know, haircuts and meals out and so on that we would want to, but we can consume goods. And so manufacturing has had a head start because you can still buy things, whether in shops that are open or online. So manufacturing has done better than services, but you can see from the chart on the right hand side that the service sector is also expecting a very strong next few months. As I said, that manufacturing strength is expected to continue, but there is a question of whether demand then shifts towards services. So we've spent a year buying things. Maybe you bought some exercise equipment, maybe you bought a new lawnmower, maybe you've done some improvements on your home, you've bought new sort of appliances, durable goods, but now you're ready to go out and start spending your money on, you know, holidays, massages, hair appointments, meals out, and that kind of thing. So there could be a shift from manufacturing over to services, but generally speaking, the expectation is that actually all sectors of the economy are going to have a good performance, definitely through the end of this year at least. The signals on the job market are pretty good too, and this has always been, you know, one of our most sorry, can I just ask again that everybody mutes their line, please? this is been one of the areas of one of the biggest areas of concern has been the labour market. So it's all very well that the economy has held on, companies haven't gone bust, they've survived, but you've still got all these people on furlough, and the worry is that when the furlough support is withdrawn, then actually all those people become unemployed, and a big rise in unemployment tends to be negative. It's negative for the amount of people spending money in the economy, it's negative for confidence, it's negative for the housing market, and so on. But actually these signs are so far pretty good. So you can see the index of job adverts on the left hand side all the way back up to where it was pre-COVID-19, particularly in Northern Ireland, which for some reason is having a particularly strong labour market revival. And then on the right hand side, I think this is an interesting chart. This is company and corporations. Don't look at the slump at the end of the year, look at the left hand side of the chart, and what that's telling you is that more people have gone out and started their own company in the opening weeks of 2021 than did in the same period of 2019 or 2020, before we kind of knew about the virus, or we realized that what the virus was going to do. So that's telling you that there's a pretty high level of confidence out there. So the signals for the job market, I think, from both of these indicators are very positive. And the unemployment rate has actually started to fall back. We got to 5% and we've pushed back down to 4.9%. That is positive, but you know, it probably isn't the end of the story when you've got still 13% of the workforce on furlough, and that, you know, still equates to something like 4 million people. So there's still this huge question mark of what happens to those 4 million people when the government withdraws that support in September. Do they go back to doing their old job, their old hours, their old pay, everything returns to normal? Do they move on? Do they lose that job but then easily find another job, or do they become unemployed? And that's the big question for economists and for all of us as we look ahead over the next year or so. Because apart from that, everything's looking pretty good. But this is the major risk, or the other risk that I hardly dare mention because it's too depressing, is of course a variant of COVID that resists the vaccine and takes us back to square one. But I think the evidence on the vaccinations is pretty good at this point. Just one final point on the labour market is that we've got mysteriously high pay growth at the moment in the UK economy. It's pay growth is about 4.5% year on year, and that is higher than anything we've had since before the global financial crisis. Now there are a couple of possible explanations for this, and generally it's an unequal story. One is the composition effect. So essentially you're comparing average pay a year ago to average weekly earnings now, but the groups of people now versus a year ago have changed. So a lot of people who were earning low wages, who were on 0 hours, who were on part-time, they have become unemployed and they're no longer in the comparison. So when you compare this group and that group, actually you're getting an artificially high rate of growth. But even if we strip that out, we've still got pretty strong pay growth in the UK economy, which is not what we would expect after a pandemic and the worst recession in 300 years, and when we've still got 3.5–4 million people on the job retention scheme. So, and again, it's a question as to how far that continues. It does seem to be, again, an unequal story. So it depends which sector you're in. The public sector is seeing good pay growth, as you can see from this chart. The financial sector, allegedly, is seeing good pay growth, whereas growth in, as you would expect, hospitality, construction, manufacturing, is considerably weaker. But I guess the reason why economists and the papers and the politicians are promising great things economically is this: savings, accumulated savings from the year of fun that we didn't have. So essentially, you can see on the chart on the left what happens in the COVID crisis. You can see a little dip in our incomes. I mean, it was a big dip historically, but it's nothing compared to the fall in consumption. So the difference between what's coming in and what's going out has been huge, and by our calculations it makes for about 140 billion pounds of excess savings. That was 140 billion pounds more than we saved in 2019, and that's why economists, particularly the Bank of England's chief economist Andy Haldane, he says the UK economy is a coiled spring waiting to unfurl. And this is exactly why, because here is 140 billion pounds of free money waiting to be spent, and so much pent-up demand, given we've all been sitting at home not spending as much as we usually do. But I want to inject somewhat of a note of caution on that front, because it is, again, it's a very unequal story. So on the good news front, and I like this chart on the left, which the Office for National Statistics published, and it was a bit of a surprise to me. We're actually more sociable than Italy and all these other countries here, the G7 nations. Social consumption accounts for a significantly higher portion of our GDP. So again, it means that we had a worse 2020 because more of our economy is dependent on social consumption, but it should mean we have a strong revival as we get back to our old habits. But just to pour a little bit of cold water on that, we actually did this survey in February, so it was after the good news on the vaccines had begun to come through. Perhaps people would be a bit more cheery if we asked them now, but we asked them in February, and I've put a few charts from this survey in, because they're telling of a consumer recovery, but not a consumer boom. So for example, the chart on the right hand side here, compared to last year, do you expect to save more money, less money, the same, or I don't save any money? And you can see that actually only 24% of people said I expect to save less money. Now that should be almost all of us who've kept our jobs. If you've kept your job and your consumption has fallen off a cliff, then chances are you're going to save less money in 2021 than you did in 2020. And yet here we have only 24% of people saying that. So people aren't saying we're going to go crazy and throw caution to the wind. This one just drills down a little bit more specifically. Would you expect to spend more or less than an average year on international holidays, domestic holidays, entertainment, and eating out? Now, there's a good number of people saying we'd spend more or much more. Most popular answer, about average. But there's also a greater percentage saying, actually, I expect to spend less than an average year. So you might think, well, maybe people are still scarred or cautious or worried about the future and not planning to go absolutely crazy, and thinking, actually, I've saved some money, it's long overdue, I'm going to keep it in savings. Just a couple more from that same survey that we did in February. Would you expect to spend more on durable goods? Actually, more people did expect to spend more, but still the net balance is negative. In other words, more people expected to spend less than average than expected to spend more. So this survey just offers a bit of pause for thought, I think, albeit, you know, these people who answered the survey might have cheered up since February. I do think it offers a bit of pause that people aren't expecting to go completely crazy. Chart on the right might be one possible explanation, which is that 43% of people expect interest rates to rise in the next year. This is a survey from the US, but I think it's very interesting. How would you spend the third stimulus check? So this is, of course, Joe Biden's stimulus program, which includes checks being sent out directly to every citizen. What I find really interesting is the top two answers here, which both getting about a third of the population. The top answer is savings, the second answer is food. So you've got people who are saying, I need this money so little that it's going straight into a savings account. And then you've got the next most popular answer is, I need this money so much that I'm using it to buy food day to day. That is a divided America, and you can see across the categories the same thing. You know, some people are saying, oh, you know, I'm going to go on a nice holiday, and some people, I'm even going to invest in cryptocurrencies, and some people are spending it on food, housing, childcare, the very basics. So the point I want to make with this and the next survey is that not everyone has saved money. Some people have had a very, very rough experience in the pandemic and do not emerge in a better financial position by any means. And this is a survey done by the Bank of England, which shows, yes, if you are high income, retired, or middle income, then yes, your savings increased in 2020 during the COVID-19 crisis. But if you are furloughed, low income, or unemployed, then if you had any savings to start with, chances are you've run them down during that crisis. So this might explain why our survey is a little bit muted. Now, I know if any of us have been out to our high streets on a sunny weekend since the reopening, it does seem that there is a lot of pent-up demand, and I think that's absolutely true. But worth remembering that we're only seeing the amount of demand that can be accommodated outside immediately after reopening, and actually there are a lot of people in this country who have had a very tough year indeed and don't have excess money to spend. A couple of slides just on Brexit. It is still probably a bit early to say what the lasting impact of Brexit is on the economy, except to say that it hasn't been, I suppose, the catastrophe that many people might have warned it was. We did see some huge falls in trade volumes in January, and you can see those are still evident in the chart on the left, despite a bounce back in the February data. You can see EU exports and imports falling considerably more than non-EU trade. But there was a big bounce in February. We'll get the March data on Wednesday. The February data showed exports to the EU back to their kind of 2020 average levels. So taking into account the fact that we're in a pandemic, they were kind of around the same level that they had been during the months of 2020. So it hasn't been a huge catastrophe yet. The chart on the right, I think, is interesting. It is showing a little bit less momentum for UK manufacturing or exporting manufacturers than we see in the Eurozone. So historically, very, very correlated. But since January, you see the UK considerably underperforming in terms of new export order growth, and that, I think, has to that breakdown of the correlation has to at least partially reflect Brexit. Brexit still isn't over, unfortunately. This is a list of dates for the diary of Brexit and economy nerds like myself, but there are still plenty of grace periods in place which are making things a bit easier for now, and which will expire. Maybe they'll get extended again. You can see the red text where these grace periods have been extended, but at some point, things that are making things a little easier now will be removed, and there will be more disruption. And I think another important point on that is on the service sector. As I said earlier, the service sector has been hit much harder by COVID than the manufacturing sector. And so, any impact from Brexit isn't necessarily going to show up when the whole sector is kind of shut down anyway. But as restrictions start to be lifted, and for example, UK musicians start to want to go on tour in the EU and that kind of thing, that's where the complications of Brexit will start to emerge. So it's been a mixed picture, but it obviously hasn't been the catastrophe that many had feared. For some businesses, it has been extremely hard, but net on a macro level, it's been complicated, a bit difficult, but not necessarily yet causing any major. There's no major evidence in the data of a permanent huge amount of damage. To finish off a little bit on policy and inflation, because a lot of people are getting very worried about inflation being about to take off, and with good reason, I think. If we go back to our economics textbooks, it's all about supply and demand. So if you think about it, the pandemic has hit supply because we've all been producing a lot less goods and services than we usually do. So that's a big hit to the supply side. And then on the demand side, as I've just said, we've got £140 billion of excess savings waiting to be released into the economy and spent. As well as that, you've got, very low interest rates, which stimulate demand, and pretty high government spending as well, which stimulates demand. So people are worried about inflation. And some of these surveys suggest that they are right to be. The one on the left is producer price inflation, year-on-year change pushing higher. And then the one on the right comes from that same PMI survey, and it's just asking companies, have you put your input prices up and down, and have your input prices gone up or down, and have you responded by raising your own output prices? And you can see that most of those indicators are pointing upwards. Now, if I just go back to the previous slide, you can see from our forecast that we broadly think inflation is going a bit higher, but it's remaining pretty much, the black line is CPI, that's the measure the Bank of England targets. It looks for a rate of about 2%, and we expect inflation to remain around that level. And that is because, yes, you've got these upward pressure factors like like the demand and all that pent-up demand, and the 140 billion pounds of savings, but you've also got something else on the demand side, which is higher unemployment, which we do expect once the job retention scheme falls away, but also the factors that have been keeping inflation relatively low for the last decade, and part of that is technology. It's about big tech companies being able to do things for cheaper. It's about price transparency. It's about any price that you see, you're immediately going to go on the internet and check whether you can get it cheaper elsewhere, and that is a pretty powerful way of keeping inflation controlled. So our view is, it comes up a little bit, but it's not about to take off. Having said that, the financial markets are concerned about it, and as I said, and as the slide says, has gone from expecting rate cuts to rate rises. So this is essentially just what the financial markets are pricing in terms of the moves in the Bank of England's bank rate, which is currently just 0.1%, 10 basis points. You can see MPR is a monetary policy report. So this is the quarterly report that the Bank of England publishes to tell us what it's thinking about the economy and prospects for interest rates. You can see that in February, the February update, at the time, we were all talking about negative interest rates. I know that I mentioned negative interest rates last time I spoke to you in November. It felt at that time, certainly, that it was more likely that you were going to get a cut to bank rate than a rise. But you can see what's happened since then. The market now expects rates to go up. So, we haven't got that in our forecast, but I think certainly the way the wind is blowing, with the economy recovering quite strongly, with inflation a little bit higher and threatening, in some people's view, to go higher still, it does feel now that the next move in interest rates will be up, but not to anything like, I think rates will stay very, very low by historical standards, but still could start to rise. So, for example, in March 2020, when the pandemic hit, the Bank of England cut rates from 0.25% to 0.1%. So the first move will be to reverse that, so to raise it back to 0.25%. Hopefully won't be a game changer for many people. Most people have a fixed mortgage, have taken out other loans at fixed rates or at very low rates, or businesses have taken up loans with government guarantees. So the small amount of rate rises that are in this profile hopefully won't make too much of a difference. That the people who will find it the most painful, I think, is the government, which has been the biggest borrower by far over the pandemic. Which takes me to what I think is my final slide, which is on fiscal policy. And what I wanted to say here is that government spending is going to remain elevated. So you can see what happens to government spending and revenues in the pandemic. Spending, obviously, is that little mountain on the right-hand side. So that's the job retention scheme and the business grants and all the other things that the government spent money on to prevent a worse economic outcome. That comes down, but you can see where that dotted line settles. It settles higher than where it was pre-pandemic. And that's because this government has some big plans for spending. Net zero carbon emissions by 2050, 40 new hospitals, the levelling up agenda, which I think we'll hear more about tomorrow in the Queen's speech. All of these things, much to the unhappiness of Labour and Keir Starmer, because the Conservative Party has basically taken their thing, which is to be a big spender, an investor. And the government is saying, yeah, we're going to keep doing that. And you can see from this chart, the gap between revenues and expenditure stays quite wide. They're not trying to close that deficit. Like George Osborne was always talking about closing the deficit. This government is not. But if they do decide they want to close that gap, then they don't want to scale back these spending plans, then they will have to do that through tax rises. And this chart already incorporates the corporation tax rise that was announced in the budget, so they need to do more than just that. So it looks like, you know, they're just going to keep borrowing about 3% a year, and hope that interest rates stay nice and low for them. So that concludes my slides. I will stop sharing my screen, and I'm happy to take any questions if there are any.
Liz, that was excellent as usual, and definitely lived up to the billing. I can certainly say that. I've got two questions for you, actually, just if I can jump in just before everyone else. And I don't know if you can answer these questions or not, but I'm going to put you right on the spot, and just please say no. Get lost, Nick. You're asking me ridiculous questions, but still. Any idea of the financial impact if Scotland does become independent, and perhaps a bit more with a bit more local bias? Have you got any idea of the impact on our region of the Liverpool Freeport? Because I know it extends, you know, I think it's about 40 miles outside of Liverpool city centre. So it's quite a large impact and potentially a game changer for a lot of areas. So there you go. Put you on the spot.
Sure. You know what, I'm a lot more confident on question one than question two, to be very honest. I think, you know, freeports do have their clear advantages, although I see in the FT today they're casting some doubt on how far they will manage to be completely tariff free. But yeah, I think, you know, clearly there's some real positive implications from that. I couldn't really start to quantify it. I haven't done any work on that, but you know, I think this government is focused on diversifying activity away from London and the southeast, and the free ports are one important part of that. On Scotland, yeah, this is something we have done some work on. So first of all, the financial impact, I mean, it depends on whether you're talking about Scotland or what would be left of the UK. For what would be left of the UK, the financial impact would actually be slightly positive, in the sense that that we are a net subsidizer of Scotland. You know, Scotland spends more than it contributes in taxes, so the rest of the UK would be slightly richer. In terms of GDP per capita, we would be slightly richer. For the Conservative Party, they would be very happy, because you know, historically opposition to them comes from Scotland, the Scottish National Party or Labour or whatever it is. But of course they wouldn't be happy, because I think three reasons really. Number one, we've spent 5 years divorcing from the EU. It's been painful and torturous and complicated. Scotland would be even more complicated, because we're not just in a sort of a trade union with Scotland. We're in a monetary union, we're in a fiscal union, we're in a political union, we're in a 300-year-old country union. It would be so complicated, and that's the last thing the UK wants, is to go into that same process all over again. So that's one thing. The other thing is they don't want the domino effect. They don't want Wales and Northern Ireland to start thinking about, well, maybe we don't want to be part of the UK either. And thirdly, I think, you know, just the scope of the UK, our global reach, our geopolitical position, you know, I think the government won't want to see that diminished further as well. For Scotland, I think, well, one question is, do they take on, I mean, the plan at the moment seems to be that if they were to become independent, they would acknowledge their share of UK debt, and they would pay the UK an annual payment towards the servicing of that. As long as they do that, you know, I think they will be relatively creditworthy. But there are big questions for them. Number one, their deficit is much bigger. Not only is it bigger than the UK public deficit. It's bigger than any member of the EU, and Scotland would want to join the EU, but the EU says you need to limit your deficit to 3% of GDP, and Scotland's is more like 9%. So that's going to cause them definitely some problems. What currency do you want to have? Are you going to join the euro? Are you going to sort of unofficially peg the Scottish pound to the UK pound? Are you going to go out on your own with a new currency? There are a lot of difficult questions for Scotland. So I think the UK government will certainly seek to prevent the referendum happening and independence happening. I mean, we just don't know, because obviously Nicola Sturgeon, I think, isn't going to take action immediately. I think it's probably going to be more like the beginning of next year that she puts her legislation forward to become independent. Yeah, we'll see what the polls are saying then. If the polls are saying that, you know, a majority of people in Scotland do want to be independent, then it starts to look pretty bad of the UK government. As Nicola Sturgeon says, you're essentially saying this is not a voluntary union of nations, and we're keeping you in against your will. So it's going to be very complicated, and I suspect it's going to be an issue that finds its way into my presentations for the next couple of years.
Oh goody, some more equally confusing Brexit negotiation. I don't know what will we call. We'll call this Scotzit or something. I don't know.
Exactly. Yeah.
Scotzit. Does anybody else have any questions for Liz? Someone just mentioned on the chat there Spain wouldn't be happy about it either, because obviously their problems with Catalonia. So that would be interesting.
Absolutely, which is going to be another complication for Scotland trying to join the EU. I think that's a very good point.
Yeah, absolutely. So anybody else, if you want to use the reactions button to raise a hand if you've got any questions for Liz. No? Okay, well, oh, hang on. Katrina, yeah? Just it's an applause, Liz. Sorry, it wasn't a question.
Thank you, Katrina.
Okay, I'm really very sorry to have to tell you all this, but unfortunately, we've had some technical issues getting hold of our other speaker, Laura, and I'm afraid we're not going to be able to bring her presentation to you. I'm really sorry about that. It's entirely out of our hands. I'm really sorry. We will do our best to make sure that we get Laura for the next event, and we will let you all know about that. So sincere apologies, and hopefully we'll see you all at the next time. But for the time being, we've got an early dart, so you can all go off and get an early sandwich. Thank you all very much indeed for this morning. Liz, thank you very much. It was really good, as usual. Hopefully we'll speak to you all soon. Thank you very much indeed.
Thank you.